evens are trading here now, guys. 82 evens are trading. Paper comes in a big seller. 81 evens are trading here now, guys. 79s are trading.
What is going on, traders? This is going to be a video about the Monte Carlo simulation as it relates to us as traders. So this first little area is going to describe what the Monte Carlo simulation is, and then I'll have another little section on why does it matter for traders, how does it apply to traders, what are some of the things that you should start thinking about, and then finally I'll go to the charts and we'll look at some examples and tie in some of the previous ideas about Monte Carlo simulation and how it applies to traders and sort of bring it all back together. So without further ado, let's get into it. The first section here is defining what the Monte Carlo simulation is. And all the Monte Carlo simulation is a big compounding calculator that randomly assigns wins and losses according to the predefined winning percentage for that simulation. And so you're like, I'm still confused. Okay, let's define it. Let's say these are 10 trades. Okay, it looks like it's a plus sign, but it's actually 10 trades. So this is trade simulation 1 of 10 trades. This is trade simulation 2 of 10 trades, 3, 4, 5. So we could also say this is trader 1, right? So trader 1, a check mark is a win and X is a loss. And so he's going to do 10 trades and he's going to start with a loser, a loser, a loser, and a loser, and then the rest of them are all winners, right? Probably the worst check marks in the world. Then trader 2 is going to have a winner, a loser, another winner, a loser, another loser, right? And then a winner and a loser. And then a few more losers. All right, got to count these out. 1, 2, 3, 4. And then another winner. What are we at? Yeah, so six winners, 4 losers. And let me put this. So this is the winning percent per simulation here. Anyways, that correlates to this, what I'm doing. Okay, and then trader 3 is going to be a loser, a winner. He gets kind of lucky. He has 3 wins in a row. And then a winner, a loser, winner, 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 and then 2 more losers at the end, right? Trader 4, he's going to have a totally different, he's going to have totally different random order, right? So random, and we're going to say trader 5 has another random order of the way that his winners and losers fall consecutively in his trading. And this is to be expected, right? Because trading's not perfect. We don't get, let's say if we have a 60% win rate, we don't just get 6 winners in a row, then 4 losers in a row, right? The order of wins and losses over a period of trades is going to be randomized. Okay, so what the Monte Carlo simulation does is it takes a single Monte Carlo simulation series and then it plots all the trades, and then it shows your beginning account balance, and then what 1% of the compounding next account balance risk would be, right? So as you see here, this guy's got a string of losers here. His account goes down, so the risk goes down as well, because it's always 1% of the current account balance after your win or your loss. And so then this shows you the amount gained or lost on 1% risk. And then this is the result. Was it a win or a loss, right? And then this is the percentage of capital, initial capital that's been won or lost. And so that's what that is. Up here, we have the inputs. And the starting capital here, we're going to say is 10,000. How much are we willing to risk as a percentage of account per trade? So we're saying 0.01 or 1%. The winning percentage per simulation, so your average winning percentage for all your trades, 60%. And then what's your risk reward? In other words, take your average winning trade size and divide it by your average losing trade size. That gives you the ratio. Okay, so if your average winners are the same size as your average losers, like exactly, then you're obviously, if you divide, let's say 500 by a 500, what is it? 500 goes into 500 1 time. So your risk reward average, or R average, many people like to say R, is 1. Okay, so that's what this is calculating. And then here, this is the statistical probability of consecutive wins and losses, given this information. So after 100 trades, you would expect to have 5 losers in a row, and you would expect to have 9 winners in a row at some point too. And why is this useful? Because it kind of just can help you recognize that it's okay to have sometimes a string of losers, and if you have edge, just get back on the horse and keep playing, right? Because it's the law of averages over a large period of trades that matters, right? And so anyway, that's all this is, just using statistics to find the number of the potential number of consecutive losses and wins. And then this is just an example of a single Monte Carlo simulation series. What this graph up here does, right, and kind of graphs this, is it's 200 of these simulations with 100 trades per simulation, and then it graphs each simulation on a chart. And so you get the outliers to the downside, and then you get the big outliers to the upside, based on what? A random order of wins and losses at the 60% winning percentage. And so this is what the Monte Carlo simulation does. And so to give you a few examples of what this looks like with different winning percentages. So if you have an 80% win rate with a 1R average, what is this graph here on the right side look like? Wow, look at that, right? You're going to be rich. After 100 trades, your return on investment is 75% on average, right? So this is the outliers to the downside. Every single one of these simulations, as you would expect with an 80% win rate and a 1R average, is like this. But what if, let's say, you have a 2R? Oh, this gets ridiculous with compounding, right? Doesn't it? Okay, 40,000. You're 300% or 400% return. Okay, but what if your win rate isn't so high? What if it's 60%? Hey, you still, everyone's profitable, but some are very lucky, and the vast majority are somewhere here in the middle, right? And so this is what the Monte Carlo basically essentially tracks. And so here starts, I guess, section 2 of this little Monte Carlo simulation. And so in this section, I'm just going to talk a little bit about how is the Monte Carlo simulation relevant to your trading. We've kind of covered what the Monte Carlo does and how it calculates, and how it is just a simulation that randomizes the order of wins and losses, and how that can really affect your bottom line when trading. But there's another part to the Monte Carlo simulation, which is what can you expect from a proven trading system with a certain starting capital? What can you expect in terms of returns if you sort of have a winning strategy and you only have so much capital starting out? Can you do trading full time? And what kind of strategy is best for you given your psychological predispositions? Another thing to consider is the extreme equity drawdowns that occur with the higher percentage of risk of your account per trade. So I just want to show you guys the differences that occur when you start to adjust the various factors that go into calculating each 200 Monte Carlo simulation series. So I want to show you guys here. Here you have a $10,000 account, and if you risk 1% of your account per trade with a 60% winning average, you are a fabulously wealthy trader. But 60%, I'll just tell you, winning 60% of the time with the risk reward of 2 to 1 is very, very, very difficult. That is, if you can do that, you're like the top 1/10 of 1% of day traders. And even then, I would be surprised if you could replicate that in, say, a bear market after maybe doing that a little bit in a certain kind of very ultra bullish bull market, right? Something like that. So even if you're performing very, very well in a bull market, it's often very difficult to replicate your strategy in a bear market and turn over that strategy as often. Okay, so let me show you a little example here of maybe a more realistic winning percentage. Let's say you win 35% of the time with a 2 to 1R, right? What you can see here is that the vast majority of people are flat, okay? Now, let's say you win 55% of the time, right? So I would say this is probably not a great strategy. 35%. All right, there we go. Okay, so let's look at this strategy, right? This is saying that your stop loss would be around down here. Your entry, which we'll say is the yellow line, would be here in a market, and your take profit would be 2 times that. So here, here, and about here, right? So if you were to visualize your 2R winner, your entry would be like right here, right? And then your stop would be here, and your take profit would be up here, okay? And so in such a strategy, your winning percentage, let's say, is 35%, and your risk reward is 2R. If you have a 35% win rate, you might be one of the lucky few that has a bunch of winners sort of at the beginning. And then you have some losers and some drawdown, and then a bunch more winners up and through this area. And so what ends up happening, for just because of the random distributions in wins and losses, you might be one of the lucky few that takes a $10,000 account after 100 trades and, makes 2,500, okay? Or something like that, or maybe $3,000, right? At the end of the whole, 100 trades that you do. But you also might be one of the people down here that loses $2,000 with that strategy. The Monte Carlo is exceptionally useful to help traders have a realistic approach to their returns. If you're one of the people that has returns like this over 100 trades, okay, and you have edge, you back-tested edge, well, maybe the next time that you perform such a strategy like this, or execute such a strategy like that up here, maybe the next time you'll be one of these people that where the strategy pays like this, right? And so you have to consider, if you run the Monte Carlo and you have a distribution curve that looks kind of like this, right? This is probably not a good strategy because the mean is somewhere in here, right? It doesn't return a whole lot. And so that's good to know, okay? So playing with this and looking at, okay, well, if I can get this up to, say, 40%, what does that look like? Still some losers, but there's a lot more winners, right? All these separate traders with different randomized losses and wins in their string of wins and losers. They're performing differently, but far greater number are above, breaking even. Okay, so let's say if we move this up, 45% win rate. Now at the end, there are no losers. Okay, so what this is allowing you to do is to take your strategy that has been back tested, and little side note, different ways to back test things if you don't have an automated trading system, right? You can use a simulation, you can use your history of actually trading, you can go and back test the market, at 2x speed and try to make your trades a little bit more quickly if it's a little too slow. That's a little difficult, obviously, because if you have a memory of the market and you know where it's going, that's going to affect you. But, if you take some random stocks, and you can do this in, say, Thinkorswim. If you take some random stocks, you don't know where they were, and make sure you don't know how they reacted, and you take your strategy and you try to apply it to that, you can go get an idea of what your strategy will look like in the past. But it's important to have as much data as possible so that you can get an idea of whether your strategy is going to work. But even so, let's say you're trading futures, right? And you're like, okay, here's your stop loss, here's your entry, and here's your take profit. And you put a little risk reward tool on there, and you quickly see 1, 2.5. This is a 2.5R strategy, and you're going to use this the vast majority of the time. You're going to try to get into trades here, right, and have your stop loss. Well, we'll say this is 3 points, right, or 12 ticks in the ES if you're trading that. 12 ticks ES, and let's say if it's 2.5R, it's so 3, 6, 7.5 profit taker, right? Now, if you can get 45% out of this, you're most likely, for every 100 trades, you're going to fall somewhere in here. So if you're a trader with a $10,000 account, you're like, hey, I want to trade for a living with a $10,000 account. Back tested my strategy for 3 or 4 years, and man, I'm consistently profitable with this $10,000 account. I want to risk 1%. And if your strategy uses a 45% win rate and with a risk reward of 2, and you've consistently achieved these results, you could say, how long does it take me to achieve 100 trades? So maybe you trade in and out 4x per day. 4x per day, and there's 5 days in a week. So 4 times 5 days equals 20 trades a week. So 20 trades per week. Do this. 20 trades a week times 5 weeks equals 100 trades. So, 100 trades. So every 5 weeks, you can turn over 100 trades with this win rate and that risk reward. Then essentially, if you start with $10,000, if you're the most unlucky person, you're going to be just above break even. If you're about middle of the road, you're looking around 13.7. So you're talking about a gain of 37.50. So does that work for you? Do you need more money? Then you have to figure out also is you need to ask yourself, does the strategy incorporate my psychology for the strategy? In other words, if you're looking at this Monte Carlo and you start trading, if you only have a 45% win rate, are you okay with having, after 100 trades, almost 8 losses in a row? If you have a string of losers, right, and you get like 8 losers in a row, how unhappy are you going to be after you've had 8 losers in a row? Are you going to be depressed? Is your confidence going to be way down? So you have to consider that, yeah, you're not a robot. You're a human being, and after you have if you have a 45% win rate, that might be a very good long-term strategy to make money in the market. But at the same time, winning 4.5 out of every 10 trades means that you're going to have strings after 100 trades of this many losers. After a 5,000 trades, you're going to have potential for 14 or 15 losers in a row, right? How messed up are you going to be? How shaken in your system are you going to be if you have this many, 10 losers in a row after 500 trades? You have to consider whether your strategy is the right one for your psychological makeup. If you start looking at, well, I want a 65% win rate, and at a 65% win rate, it's a little harder for me to get as many winners with the 2R strategy, so maybe my strategy is 1.25 Rs, right? Okay, well, essentially we have to ask the question, what does the payoff look like? Can you even get 1.25 Rs out of a 65% win rate? That's the question, right? Maybe you don't even get that much. Maybe you get a 0.9 R because you're getting into trades, and let's say the market's oscillating or something, right? And you see, oh, this is a nice little flag. It breaks out here, and so you get long essentially here, and then you have to figure out a stop loss. So you say, well, my stop loss is here, and then your take profit is somewhere up here, and that's slightly better than 1R. But what if the market makes a move and it goes up to here, right? And what was support kind of turns into resistance, and then it starts to curl back. And meanwhile, you've taken your stop down here and you've moved it up to break even. Break even plus 2 ticks or something. And so in this trade, the market's moving and it oscillates here, it oscillates here, it oscillates here. Meanwhile, you're moving your stop loss up a little bit, and then finally, and maybe this is prudent for your trading, it takes out your stop. And then, so your winner is actually from here to here, right? And so your winner's up, that's 0.5 Rs, right? We could just see it by looking at it. So your winner is 0.5 Rs. And you do this so many times per day to where, you're still winning 65% of the time, but now your win rate starts to suffer a bit. And you're at like 0.82 Rs, right? Enter that into the Monte Carlo. Are there some unlucky people? Yeah, there's one unlucky person here. Look. It turns into a big loser, right? The account never quite recovers with this win rate of 65% and a 0.82. The vast majority of people are still in the green. You see that? This is like, well, somewhere in here is about the average. See that? And so you have to start looking at your statistics and figuring out, what works for the type of personality that I have. Do I need to have a little bit better, higher of a win rate? What if I like to have at least an 85% win rate? If you want to have a higher win rate, a lot of times you have to have a little bit wider stop and give the trade more room. And often with people who have higher win rates, they're cutting their winner a little bit short of their target, or a lot short, because they'd rather just have a high win rate rather than a whole bunch of losers that hit full targets. And they also are often, the scalper types are also wanting to not let the trade run to its full target, because out of how many trades when you're scalping, how many turn into really, really big winners? 1 out of 5, maybe less, right? And so you'd rather take, say, a point. So in this situation, obviously it looks very good with an 85% win rate with, what was it? I can't remember what the average was. 0.8 or something? 0.8 something? No, it's probably lower. So anyway, let's just say that your risk reward is 0.7, right? What does that look like? With the high win rate, it's still fine. You're still making good money. But now, what if you go and you do what we just showed in our prior example? We do 0.5, right? Hey, everybody's still winning, but you're really over 100 trades or 5 weeks with the 4 trades per day example. You're only at about $3,000 returned over a month and a week, all right? And then, or subtracting holidays, you really are maybe trading, maybe it takes 6 weeks to do 100 trades. And that assumes the market's giving you, again, 4 opportunities per day according to your edge. But the better setups occur less frequently. And so it may take you longer to get that return if your setups are occurring less frequently. So you need to think about that and start plugging things into something like this. If your win rate is 80% in reality, for every single trade, and your risk reward, like your stop loss is 1 point and your take profit is half a point, and you win 8 out of 10 times, this is what your return looks like. There's a few unlucky souls that barely go above break even. And so as a trader, you need to start tempering your expectation. If you're one of these people that you go back and you say, I have an 80% win rate with a 0.5 R return, and you're way up here looking forward using the Monte Carlo, you need to tell yourself, hey, wait a second, I'm an outlier right now based on what's happening. I need to not expect that this is going to continue moving forward. And likewise, if you're a little depressed, you're barely making any money, and that is your win rate, you look back statistically and find that is your actual win rate, well then you need to realize, I need to keep doing this, because with this win rate and this reward, I'm likely going to be up here. And if that's acceptable for you, maybe you have a $100,000 account and over 100 trades, that's acceptable for you to be up here. And we can change this real quick. Maybe for a $100,000 account, a $20,000 return every 6 weeks or so is perfectly fine, or maybe not. So you have to really consider what the strategy does for you long term. So, use something like this and play with it and think about it. Okay, so the next part of this, I guess, 3-part series on Monte Carlo in risk is actually looking at examples from the market and getting an idea of what it looks like to put on smaller risk reward trades and bigger risk reward trades. And when we're at the hard right edge of the chart, what does it look like to put on those trades, right? And so here we are. This is a live market here in the E-mini in the Globex session here. We've rallied a bunch, and maybe we're coming into some kind of resistance here. Here's the footprint. We'll drag it down. I'll adjust the scales a little bit, and we see here a little absorption, and then we come over here to our basic volume chart with the E-mini, drag it down, and we look over here and we see pretty basic bull flag here, and so we think, continuation higher. Even though there's a little absorption, I'm going to assume this market's going higher. So if you're the type of trader that structures your trades based on a very high risk reward of, let's say, 4 or greater, you might do something like this, right? Where you enter right here, right now, you put your stop under the low, and you put 4 R's on the trade. But in the real world, what ends up happening is it comes down, goes sideways, and then it makes a little stop run, and then it goes. And so let's say that happens in this trade. It comes down, comes back up, comes right to the middle. Now, what do you have to decide again? Do you want to re-enter? Was that a little false breakout? Okay. Do you re-enter at the exact same point, right? Okay, if you say yes, you do you put your stop underneath the breakout low, or do you put, or the false breakout low, or do you put your stop right where it was, right? For structure's sake, I'd say you have to put your stop under the breakout low. Okay, so you're re-entering here, and you're putting your stop underneath the breakout low, which is, say, here. So let's go back. Oh, back. Now when you're re-entering this trade here, right at the same level, maybe it has a higher probability of success, but again, your strategy is 4 to 1 R's. So if your stop is here, you need to adjust your profit taker up to 4 R's, right? Now it's at near this all-time high resistance. So you see how your entry completely changes your risk reward and your strategy. If you continually get stopped out on little false breakdowns, the right thing to do maybe is to put your stop below the low, or maybe there's a volume node that builds. Maybe you can tighten it up based on, you see a high volume structure that builds on the footprint or something like that. But maybe you cannot. And so the whole idea that you can enter 3 times for a 4R winner and enter with exactly the same conditions is a little bit misleading, right? So there's one example of high risk reward trades that it becomes very hard to structure the second and third trade. So here's one example. Another example, right, just for a different strategy. Here, let's get rid of all of this, and we'll get rid of this. Another strategy might be, I think this is a lower high, I'm going to short this thing. Okay, that's fine. Let's say your stop is what? Into the high, or is it above the high? All right, let's go look at the high. What does it look like? Just a tapering out, less interest to buy up there in this session. Again, same thing, little absorption, not too big of contract value up here. And so you determine, you know what? I think I'd rather go short here. And so you take your risk reward calculator, say stop above the high, entry right here. And in this case, you're like, I'm a high win rate trader, and I'm going to put my stop like this. How ridiculous is that? Is it ridiculous? If you can constantly get filled and have a 0.82%, and let's say you have an 80% win rate on these kind of strategies because you play ranges or you play extremes, and you put about a 0.82R stop loss at 80%, can you have success trading that? And so let's go look at the Monte Carlo, and let's go enter that strategy in that we just looked at on the chart. We say we have an 82% or an 80% win rate with a 0.82 R's, right? We can already see the 80% win rate with 0.5 R's is pretty good. But okay, let's say we put 80% in with 0.82 R's. What does that look like? All right, it's not bad. Over 40 trades, it would return, if you write down the mean, 40,000. The worst performer returned, I don't know, 27, 28,000. With a $100,000 trading account. I mean, we could move this down to whatever, $10,000 trading account. Doesn't matter. Same idea. So in this case, again, the worst performer was about $13,000 on a $10,000 account. 30%. That is not bad. So when people tell you that any risk reward under 1 is a losing strategy, it really just depends on your winning percentage. But let me tell you something. If you're looking at a strategy that requires an 80% win rate, your room for improvement is small. Because, what's the best you can do? 100%? But your downside is that you can go all the way down to a very small percentage. So you have to be really on your game to play this type of game. And so that is a little challenging, because if the market changes its behavior, right, it goes from low volatility and your strategy works really well in low volatility, and then we go to high volatility. In high volatility, so going back to the chart, in high volatility, this stop loss might just be noise. If you're not used to transitioning to a high volatility environment, you might get stopped out really quickly here. And then just have a whole bunch of losers because you don't know how to place your stop loss correctly. And that's a whole different that's a whole different thing, right? But as you can see, this trade already, because it's a smaller range trade, it may have a higher probability of success given any, number of things, right? Maybe we're at resistance up here, and so that factors into it. But nevertheless, you can see with the different kind of example here, maybe, all right, using hindsight a little bit, right? We saw this strong close on Friday, and you're like, okay, we have this big bull bar, pulls back, it holds. So, I want to trade a strategy where I get long with momentum and I go for at least 3-to-1 R's. So let's try to, hindsight is 20/20, but let's try to structure a trade here. Okay, so let's say we're buying the breakout. So our long point is right up here, right? We're buying this breakout right here out of this bull bar, pullback bar, and now it's coming up, right? So we buy the breakout, and it's what, right here at 47.10. And then let's say your strategy requires that, okay, if you buy a breakout, if it goes halfway down the previous bull bar, you stop out. So here's halfway down, here's buying the breakout, and again, you want to go 2R strategy. So anyway, you buy this breakout, boom, you stop out. At what point do you get back into the trade? What? Where it comes back above again? Maybe that's how you do it. Okay, so let's adjust this. So you lose once, this part comes back up, breaks out again, triggers you into the trade. Your stop is the same. Now your stop is the same point, or is it? It just depends on your strategy. I'm trying to just more of a real world strategy, right? But your stop is 2 points. It comes, takes your stop again. Your profit taker's up here. Takes your stop again. Now, this is where psychology comes into play. How many times in a row are you willing to lose to get into your trade? If your strategy is a 2R type of strategy, you're already feeling like, well, shoot, if I enter this trade again and I get 2Rs, I'm just making up what I've lost in the last few trades. And then now you have sort of a poor way to think about the market, right? You're not thinking about each trade independently on its own merit. You're worrying about what you just lost. But that's with a higher risk reward strategy, that's sometimes what you have to be willing to accommodate, because with the higher risk reward strategy, oftentimes you're going to get let's say if you want to go 5R or something on your trades, you're going to get stopped out multiple times before you finally get into that trade. Now, some people have different rules. Some people say, after 3 shots at an area, that's it, I give up. But I don't agree with that. I think that you need to just reassess that area and try to, if the market's still bullish, sometimes it'll try several times before it finally goes, right? But you have to be willing to try several times with this kind of strategy. So let's say you lose 3 times and you win on the 4th, but with the 4.75R strategy. So our risk reward is this is determined right here. And let's say this is our everyday strategy. It's 4.7Rs or something like this, and then it gives us an average that is close to our strategy, right? So 4.7Rs with a 25% win rate, right? Something like that. Okay, let's go plug this in to the Monte Carlo simulation. Okay, so here we are in the Monte Carlo simulator, and we're saying 1% account risk. Winning percentage is 25%. And our risk reward average is what? 4.85. Now let's see what that looks like. Now, you can see that some lucky souls have an incredible 100% and then 200% return on account almost. But the vast majority, again, because of the low win rate and the very big winners, you get a lot of volatility in this account. Quite a number of them, 1, 2, 3, 4, 5, 6, 7 or so, actually lose money. Now, this is again out of 200 simulations. But you can see that the average is somewhere in here, right? And then there's some outliers up here, right? And so this is good because it allows us to really look at a lot of the claims that folks make about high risk reward trades with low win rates, and we can actually plug it in, run 200 simulations, 100 trades per simulation, and get an actual fairly realistic idea, right? And of course, coming back to psychology, can you handle, having 16 losers in a row at some point over 100 trades? And so Monte Carlo, it's really great for allowing you to consider what psychologically you could handle and what your system that you're trading can potentially return, because you can be an unlucky one here and not make money. That is within the realm of statistically occurring here. I mean, it's a lower probability, but it can occur, right? And so if you get a whole bunch of losers, consecutive losers in a certain pattern or certain distribution, you could theoretically, with this exact win rate and this exact risk reward, come out to be a loser. And so based on how the market is structured, you want to find some sweet spot for your trading, right? If you're 35% winner, what do you need? Is 4.85, is that realistic? Can you get a 35% win rate with almost 5 Rs? Or are you more close to about 4 Rs, right? All right, so let's let it calculate the 4 Rs. So at 35% and 4 Rs, everybody's a winner, and you're somewhere up here, and so you're returning about 100% again, based on 4 trades per day, and it's about 5 weeks until you return 100% with this system. But how many people return 100% on their futures account every 5 weeks consistently? How many people are even profitable, right? So this is just another way for you to use the Monte Carlo simulation to kind of figure out, hey, how if I'm 65 or if I'm 50% profitable, right? Let's go back to the charts and look. Okay, so back to the charts, right? If we are looking at a chart, and let's just say your strategy is based on general support and resistance, you like to buy the level, put your stop maybe 1 point below or something like that. And so I'm not saying this is a good trading strategy, but I'm keeping it simple. So you buy right here, and so you buy here at 47.19, and you like to take 1 R. How many times on different trades are you going to stop out in this type of system if your stop loss is essentially only 3 ticks? Only 3 ticks. How many times in a market do you see, say, a double bottom like this? 1, 2, and then the third time it goes and takes it out. But if you're trading a system where your stop loss is really, really tight, and you're constantly getting stopped out because it's so tight, and you're only, say, taking a 0.67 R, but you're 90% of the time, let's just say you have some sort of super duper momentum oscillator or something, and you're scalping like this, and you're really good at it, can you make a living taking 19 to 19.50, 2 ticks? 12.50 times 2, $25. And let's say you do it with 2 contracts. Well, your risk would be what on a $10,000 account? 19. Let's just say to 18.25. So 3 ticks times 12.50 is what? 37.50. And you can risk up to what? How many dollars on a $10,000 account? You can risk 1% is $100. So you can take what number of contracts here? So you can take 2 contracts here times 37.50, and then maybe a micro. But let's say for the sake of to quickly get into a position that matches your risk reward, you're looking, say, at $75 for 2 contracts at 37.50 stop. So you're 2 contracts long, and you're looking for 2 ticks. So let's go put this into the Monte Carlo. How often? Let's say you get this 0.67 Rs. You get this 75% of the time. Is this a viable strategy for you if you're a scalper? Let's go look at it in Monte Carlo. Okay, so we're risking on a $10,000 account, we're risking 1%. Let's put the winning percentage in. And we're saying that it's a 75% win rate with a risk reward average of, what was it, 0.67 Rs. How does that look? Hey, everyone's still a winner, right? Look at that. So at a 75% win rate with the 0.67 R return, you're still profitable. If you're a scalper, you're going to get more of these opportunities in the market using something, say, like footprint or some extreme momentum oscillator. You can actually manage 75% win rate with the 0.67 R. You can actually be successful over 100 trades using Monte Carlo. Even the worst person made, roughly $700-800, with the best making around 4,000, right? So depending on the order that you have your wins and losses, if you have a good system for scalping, that can be profitable too. So it just depends on what your strong points are on the setups that you use. And if you start to amass data on your trading, then go ahead and start plugging it into something like this, a Monte Carlo simulation tool, just to get a better idea of your risk. And this can really help you to sort of get a more realistic expectation of what your results should look like after 100 trades or X number of trades. And so I hope you guys, I hope that this is valuable to you guys and that you can use this kind of tool to maybe think a little bit differently about how you structure your trades and how you can find success long term. And maybe it'll answer some questions for some of you that have been trading and think you have a successful strategy, but just because you have a certain order of losers and winners, you're not finding success. And so maybe this allows you to say, well, I'm going to buckle down with this strategy because statistically, if I put this in over the long haul, this is actually a winning strategy. My problem is that I keep changing strategies every time I get, say, 3 losers or 4 losers in a row. And maybe this can help you to sort of stick with something long enough to see results over the larger sample size. So again, if you guys find this valuable, share this video with your friends, because there are a lot of traders out there that don't really consider things like this in their trading, and this is a really important part of calculating your performance using a more realistic tool to see if that strategy is actually viable for the long term. So anyway, have a great upcoming trading week, and for questions about anything in this video, come join us in the Discord. I'm not going to be answering any questions in the YouTube comments because I simply don't have the time. I'm a trader full time. I've got a wife and a little 4-year-old and a soon to, hopefully pretty soon, here the next 4 or 5 weeks, we'll have a little girl. I'm just going to really struggle for time here, probably for the next few months. I am going to be trying to put out 1 YouTube video a week, even if it's a setup or something really simple that, again, you guys know how I roll. I try to share things that are valuable, and I don't share any of the unrealistic type of claim. I'm not trying to mislead people. I'm trying to share real trading knowledge with you guys, and so yeah, I really do hope you guys share this with other traders. And if there's something that you think I'm wrong on, come into the Discord. Link the YouTube and challenge me on it. We can discuss it. Right? I'm open to that with my trading as well. I have people around me every day, the sort of quote unquote contributors section of the Discord. And if you read about the rules and guide or about in the Discord, you'll understand what that means. But I have people every day that challenge my assumptions about the market, and I like that, right? That's what we should be doing as traders. That's how we improve and grow, is we challenge assumptions and try to refine things and make them better and better, sort of the scientific method approach to trading. So anyway, thanks for watching, and again, have a great week of trading. Take care.